it's fair to say that the last week has been a little bit on the quiet side when it comes to mortgage news, and this isn't unusual for times around Christmas and Easter, with lots of people away on their holidays. So, is this the calm before the storm? Who knows? But let's have a look to see what's been going on for the last 7 days in the world of mortgages. So, we get coming up, we've got Santander have tweaked their interest-only policy. The Mortgage Works, a big buy-to-let lender, have brought out a sub 4% interest rate for buy-to-let borrowers, but there are some caveats with that I'm going to go through. And I'm also going to talk about the implications of having your mortgage application selected for a lender audit. So let's kick off first of all with lender audits. What is this? So if you're one of the unlucky people that you've submitted a mortgage application and you find out that your application has been picked up for a lender audit. Well, what does this mean, first of all? So, a lender audit means it's been pulled out of the queue from, it might have already been looked at by underwriters, it might be in a queue waiting to be underwritten. But for one reason or another, which I'll come on to in a minute, your application's been selected for an audit. So, it goes into a dark room in a head office somewhere. Okay, maybe not a dark room, maybe they can afford some lights, but it's been pulled out of the queue and it's going to be looked at by some serious people. So, first of all, what does this mean? So, a lender audit means that they're going to be looking in greater detail at your mortgage application. They're going to be making sure that everything on paper stacks up. They're happy. There's no inconsistencies. There's not any, they call it third party information, because believe it or not, mortgage lenders have access to a wealth of information from Inland Revenue, from other banks, where they can share your personal information, because you've probably signed that somewhere along the way that banks can see. There's actually something called open banking, where banks can actually see what's going on in your other bank accounts. So they're really just doing their background checks. The the difficulty with an audit is that it's going to delay things. I'll always tell my clients, look, from application to mortgage offer stage, you're looking at about 10 to 12 working days is pretty typical. If your case has been selected for an audit, I'd stick an extra couple of weeks on that. There's not many auditors working in the bank, so they're going to be, working through the queue, but it's going to delay things. Okay. It's not necessarily a bad thing. So why has your case been picked up for audit, or why could it be picked up? Well, there's two reasons. First of all, mortgage lenders have made a promise, a pledge to the Financial Conduct Authority. They will spot check. Now, I don't know the exact figure, but I have been told by some banks do 20%. I haven't quite experienced 20% of my cases myself. Maybe we've got lucky, but I have heard 20%, and of those cases, they'll go to their head office for an audit. And they have to do this because the FCA need to make sure that the banks are doing the due diligence properly, that they're making all the necessary checks, that they're looking at the risk profile, and that they're responsible lenders. So if your case is getting selected for audit, it could be completely random. Or they can do audits for a reason. And sometimes that reason is they're not happy about something on your mortgage application. So what can they not be happy about? Well, it could be inconsistencies. So how would they know there's any inconsistencies on your mortgage application if they've got nothing to compare it to? Well, actually, they might. Let me give you an example. Let's say you apply for a mortgage with the Halifax and you've already got a credit card or a bank account with Halifax. And on that product, on that credit card or on that bank account, you're listed as living at one address. And maybe you've ticked a box to say that you've got one child or three children, say. But now you're applying for a mortgage and there's a different address. And all of a sudden, you've only got one children when the last time you told them you had three children. So that's going to be an inconsistency. That's going to come up. But it's not just inconsistencies that they can see within the bank, within other products that you may have already have or that you may have already applied for. Banks can also check and compare to other previous mortgage applications. So if you've previously applied to Santander or gone to another broker and they've done some applications, maybe not even applied, just get something agreed in principle, and they have they've represented your scenario in one particular way, and all of a sudden, Halifax gets a new mortgage application, and it says something a little bit different. Maybe a month ago, you had an application that you was employed, and now you're self-employed. Banks are able to share information. Just like, I don't know whether you ever have this where you take out some insurance and they say, be really careful what you say on an insurance application because insurance companies will share the information. Banks and mortgage lenders, they're going to do the same thing. So they can see, because they've got to protect each other, they've got to make sure that they do everything possible to reduce the risk of fraud. So if they're seeing inconsistencies even between mortgage applications that have been declined from other lenders, or maybe they weren't declined, maybe you just walked away, that information might come up and that might trigger an audit. Now, as long as you've done nothing wrong, as long as you're not lying on a mortgage application, or it might be that your mortgage broker has done something on a mortgage application in error or deliberate. So always check your mortgage applications from your mortgage broker. Just make sure they're correct because it's your name on it. But as long as you've done nothing wrong and there's no inconsistencies, it should come out the other side, unfortunately, about 2 weeks later with a mortgage offer, hopefully. So that's lender audits. So let's see what's going on in the news. So let's talk about Santander. Santander have amended their interest-only policy. So what does this mean? So first of all, interest only means that if you're borrowing £100,000, for example, and it's on an interest-only basis, at the beginning of the mortgage, you borrow £100,000, but every month you're only servicing the interest. So at the end of the mortgage term, whether that's 25 years or 40 years, you're still going to have £100,000 left. But what you must have is some kind of strategy to repay that money. Now, that might be that you've got some stocks and shares. It might be a pension lump sum, or the most common way that I see is people that downsize into a smaller property and use the equity in the property to pay off the debt. So let's see what Santander have done. So looking at their interest-only policy, which is here, they have increased the maximum term from 25 years to 40 years. So it used to be with Santander that you'd have to pay back the debt after 25 years. And that only 25 years seems like a long time, and it really is, but it starts to come around pretty quickly. And to give homeowners that extra little bit of time, an extra 15 years to repay that debt will help some homeowners. Now, the other thing that they've changed is that they used to need £250,000 of equity in the property for them to grant interest only. So that could be £250,000 going down as a deposit, or if you're remortgaging, there's already £250,000 of equity. Equity is the difference between the value of the property and your mortgage size. So first of all, Santander have actually increased that to 300,000. Okay, so now they need £300,000. Now, in some respects, that's kind of a good thing because what they're doing is reducing the risk of negative equity. Would a property actually fall by £250,000 in the first place to get into negative equity? I've seen it happen on really big properties, but I don't know. I don't know. I don't think that's a particularly exciting thing there. However, they have changed the rules about who can have interest only. So what they're saying is, if you've got a combined household income, so whoever's on the mortgage, if those two incomes together are less than £200,000, you can only have interest only up to 50% of the value of your property. If your income is above £200,000, which I appreciate, that's not going to affect many people, probably the top 1 or 2% of household incomes in this country, then you can have interest only up to 75%. Okay, is this a good thing? Is this a bad thing? Well, there's lots and lots of controversy around interest only, especially because in the last financial crisis, when house prices plummeted, there was a lot of households that were actually in negative equity. So I think this is all about trying to sort of, for some sections of the market, probably a very small section of the market, allowing a few more existing homeowners to have interest only. And again, not panic that they've got to pay it back in 25 years, because they can allow now go to 40 years on an interest only. But they've got to make sure they've got a good repayment vehicle. Now, for a lot of homeowners, that will be moving out from London, because let's face it, to have £300,000 of equity in your property, you're probably going to be living in London or the surrounding area. I used to live in East London, and now a typical three-bedroom family home in East London is probably getting close to 500,000 or 600,000. So if you've been living there, maybe you bought it 10, 15 years ago, it's not unexpected to have maybe two to 300,000 pounds of equity in your property. And one of the things about having interest only is it can, or not, it will reduce the monthly payment. So a lot of people who are struggling, especially if they're living in the southeast or in London, struggling with the cost of living, struggling to pay the bills, this might give some temporary reprieve until that mortgage is paid off. Okay, so that's Santander. So let's talk about TMW. What have they been up to? Well, they have brought out a 5-year fixed rate mortgage at 3.99%. Okay, so let's go to their products, product finder, buy to let. So first of all, this sub 4% deal is only available on a buy to let basis. And on a 5-year fixed rate, we can see it here, 3.99%, the one at the top. That's on purchases, and it's on remortgages as well. So in some respects, this is good news. Now, first of all, it's done on a 5-year fixed rate, because with a buy to let, 5-year fixed rates allow extended borrowing compared to, say, a 2-year fixed rate. And for a lot of landlords who are in a situation where they can't remortgage or weren't able to remortgage previously, because the stress test in the background and the rental income weren't allowing landlords to borrow the amount they needed when they came to the end of their mortgage deal. So actually what was happening was, or is, and still going on, is a lot of landlords are stuck on lenders' variable rates because the figures don't stack up. So let's have a look at this deal. So this is 3.99%. So the headline rate is good, but you've got to have 45% equity in the property. So again, this is going to be potentially landlords who are either buying a property with a small deposit, sorry, with a big deposit, or have a lot of equity in their property already. But it also comes with a 3% fee. Okay, so it's not always about the headline rates, because a 3% fee on, let's say, a £200,000 mortgage, well, that's £6,000. So the fee is going to be pretty heavy. So is this a case of mortgage lenders being greedy and just trying to get big fees? Well, there's a lot of arguments and debate about that. This is a creative way for mortgage lenders to try and help out landlords. And they're probably lining their pockets a little bit at the same time. That's what banks do. After all, they're in it for, they're not a charity, they're in it to make money. But on a 5-year fixed rate with a 3.99% deal, when they're calculating the mortgage borrowing amount, it can actually help by having a lower pay rate, because when the mortgage is calculated on how much you can borrow, if it's linked to the pay rate on a 5-year deal, it can actually allow that landlord to borrow a little bit more. Now, that might not necessarily be borrow more for irresponsible lending. It might just be to get them the loan amount that they need to get a new fixed rate, because they don't want to be on the lender's variable rate, which might be anything up to 8 or 9%. Potentially a good deal for some. It does come with high fees, and it does need either a lot of equity or a big deposit. So there you go. That's the roundup of mortgage news for this week. Today is Monday, the 8th of April.